really interesting question. You have to understand first how money moves out in the financial markets. Money out in the financial markets move between stocks and bonds, and our home loan rates are based on bonds or mortgage-backed securities. So here's what happens, and it makes very common sense. When a report comes out, let's say there's an economic report that shows really a hot economy, things are looking good, the consumer's excited, they're spending money, everything's on fire. If you're a money manager out there choosing for the day, do I want to put money over in stocks or in bonds? If everything's on fire in the economy, you're more likely to want to put your money over into stocks. Well, when you move your money into stocks, where do you have to take it out of? You have to take it out of bonds. And as you pull that money out of bonds, and as this happens in the market, that actually means that bond pricing worsens, meaning home loan rates actually get worse on news like that. Vice versa. If you've got news that's coming out that's kind of dismal, doesn't look good, weak, the consumer's not confident, people aren't spending, things look a little uncertain and not that great out in the economy, what's going to happen is exactly the opposite. Big money managers, and even you and I, are going to move that money out of stocks but move it into bonds. A little bit safer, a little bit more secure, and as that money moves out of stocks and into bonds, it means that bond pricing is going to improve, and because we know that home loan rates are based on bonds or mortgage-backed securities, we're actually going to see home loan rates improve when we get that weak economic news. So it's very interesting that actually good news for the economy tends to be bad news for interest rates, and vice versa, bad news for the economy tends to be very good news for home loan rates.